So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. On today's episode, we want to again go back through some of the futures market basics, and I want to try to do this all in less than 7 minutes. Now, the idea behind today's call, as opposed to some of the other ones that we've just done previously, is that I want to talk about more of the structure of the futures market and just generally how it works. We talked about the E-minis, we talked about some commodity futures, but I want to kind of run through some of these specifics on just general futures contracts and how the futures market behaves and what it, can do for you as a trader or a speculator, because I think it's really important to understand. So the first thing you have to understand about a futures contract is obviously it's just simply an agreement between two people in the future for a specific asset at a specific price. That is a little bit different than implied volatility and options trading, because futures contracts have a P&L diagram that's very similar to long stock, short option, or short stock. So it's very much a one-dimensional payoff diagram. It's either just going to be at that future price higher or lower or not. There's no implied volatility basis that's factored in, because the futures contracts trade basically at the money or to a slight discount or premium to the future price. So in this case, it's a lot more similar to stocks to some degree, except for the fact that they derive their value from some actual physical asset. Now, in many cases, futures contracts are what's called cash settled, which means that at the time of expiration or at the time that the contracts expire, the only thing that changes hands is cash between investors. Now, there are some contracts like corn contracts, which are actual physical delivery. So at the time that you actually get to expiration of a corn futures contracts, you might actually have to deliver the physical commodity if you're short, or take delivery if you're long. But look, again, most people don't ever want to do this, right? Because of the holding costs and the risk that's associated with it. And frankly, like, what are you going to do with, billions of bushels of corn in your backyard, right? So many of the futures contracts end up being cash settled. And I think it's only less than 2% or less than 1% of all futures contracts that actually go through full to delivery. And so again, that just shows you that, most of this market is just, money changing hands back and forth and risk changing hands back and forth. Now, most of the contracts that trade for the futures market are traded on quarterly expirations. So March, May, July, September, December, those types of expirations for contracts. It's not always that they trade March and May. They may trade March and July and September and December, but you have to check and make sure you understand which contracts you're trading. But those are the kind of the most common months that those contracts are generally traded. And then obviously the options contracts behind them can have a lot more expiration dates, including weeklies. Now, when it comes to futures contracts, one thing that people should understand about these futures is that they do have slight premiums for longer duration contracts. And again, that makes total sense. If you're locking in a price or you're locking in a contract that's a little bit longer out in time, say, 6 months out versus 3 months out, then those longer dated contracts are going to have maybe a slight premium that's associated with that extra time and that extra risk. And that also means that they're going to have a little bit less liquidity as well, because they're further out, and that increases the cost to buy or sell those contracts. It also increases the risk that maybe not a lot of people want to be trading or speculating that far out in the future just yet. So that's probably one of the biggest differences, is just that associated cost kind of over and above an underlying stock or ETF position. And the final thing that we want to talk about with futures contracts is the leverage that's involved. Now, leverage obviously can be good or bad, but when it comes to actually physically buying stock or choosing to buy a futures contract, usually a futures contract will be a little bit more favorable when it comes to capital that you have to outlay. You'll have to outlay just a little bit of margin to cover that position, or set aside some margin in your account to cover that position, versus a stock position, you'd have to outlay the entire cost to do that. So this leverage obviously comes at potential risk, because if you're over levered and you basically get yourself into a situation where the margin on all futures contracts or on the market starts to go up, then you could run into a margin call situation. This, again, presents an opportunity for you to use a futures contract to hedge or speculate or, potentially play a different market with a little bit of capital compared to actually trying to play that market with the actual underlying value of the stocks or ETFs or kind of associated securities in that market. So hopefully this helps out. Again, I think I did it under 5 minutes or so, or right around 5 minutes or so. So hopefully that helps out. If you guys do have questions, we'll be doing more of these daily podcasts on futures trading a little bit, just to kind of start helping you understand a little bit more about how the market works and if it's worth it for you to start trading. As always, hopefully you guys enjoy. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.